Today we are looking at a European stock towards its 52-week low with double-digit dividend increases. It is Kering. They are a global luxury group that own a number of brands you will have heard of: Balenciaga, Alexander McQueen, Gucci, Yves Saint Laurent, a lot of famous ones. And today's episode, we are going to take a look and see, is Kering now looking like a very, very strong buy price? We're going to take a look at the historical information. As always, we're going to see how well the company is operating their top line revenue as well as their bottom line net income growth over the last 5 years. We're going to look at the balance sheet, their total cash versus total debt. How safe is that dividend? And we want to compare them to some other companies in the apparel and luxury goods items over the last 5 years. We're also going to briefly touch upon their recent group quarter 3 earnings to talk about how this company is positioned over the next 5 years. And as always, we're going to look at some very important financial metrics you need to understand before investing into this company. And then we will run it through that ever important stock valuation model, getting to our intrinsic value and finding out our acceptable buy price given that investor margin of safety. Now, year to date, the company is down around 17%, significantly underperforming the S&P 500. As we can see, it is towards that 52-week low of around 400 with 52-week highs of 662. And it does offer a fairly appealing yield at 3.56%. Now, investors who have been holding the company over the last 10 years would be up around 117%. That is just share price, doesn't include those dividends, which we will look at shortly. And we can see the price did peak around summer 2021 at $945, more than double the current share price. So let's find out in today's episode, is Kering severely undervalued? Can we expect to see double or triple that share price growth as well as that yield on cost into the double digits? Let's start off with their income statement, their total revenue growth. Now, what we like to see, 3 to 7% year-on-year growth. 2018, now 15.6 billion reported on the top line. 2022, their latest annual report, around 21.8 billion. So there is some nice growth over the last 5 years in this luxury brands company. And we can see, whilst we are waiting for December 2023 reports, the trailing 12 months does show that it has been increasing over the period. So we would expect to see another increase on that too. On a more granular level, well, what do we see? Well, 2018 to 19, nice growth. It did drop. Again, you could use the COVID factor and argue that that was some of the reason why we did see the drop here. And then it rebounded very strongly. And then again, it did pick up, as we see here, up by around 5 to 10%. Remember, we will look at the last 10 years in percentage form too. Bottom line net income, well, how do they compare? Well, 4.25 billion reported in 2018, 3.8 billion in 2022. So their bottom line has in fact suffered and depressed over the last 5 years. And we can see from 2018, it has decreased to 2019 before picking up all the way to 2022. And let's wait and see what the last few months for the year give us. But it is looking like it may be similar to 2022, unless there is some cyclicality with the business. Now let's jump into their balance sheet, a quick health check, total cash versus total debt. Well, what we can see here, 2.5 billion on the balance sheet in short-term investments in 2018. Now, latest report not too long ago, 3.6 billion. So they are holding a little bit more cash than they did 5 years ago. And comparing that to that all-important total debt figure numerically and directionally, 4.5 billion of total debt in 2018, 13.3 billion in their latest report. So their total debt has in fact increased nearly 5 times. In fact, 3 times. So it looks like they are taking on a significant amount more debt than they did 5 years ago. Now let's compare them to some other companies in the consumer discretionary sector. We have Lululemon, Adidas, and a few others such as Burberry. Now, year-to-date total return performance, so this does include those dividends reinvested, we can in fact see that Kering was the worst performing, down 15% year-to-date, with the best out of all the bunch being Adidas, up 31%. Now, if we extend this time horizon to the last 5 years, what we in fact see is Kering is really only up 1.6%, and that only is if you are reinvesting those dividends. So that is fairly poor. It is towards the middle of the peers. But again, it isn't what you want with any kind of investment. And as mentioned at the beginning of the episode, our whole aim is to understand, is this a company where we can expect to see the share price double or triple over the next 5 to 10 years, as well as our yield on cost increasing the same. Now, before we jump into the financial metrics, just very quickly take a look at their Q3 reporting. And what we can see, first of all, Q3, quarter three, Gucci makes up around half of their sales at 2.2 billion. And one thing to note, compared to last year, the exact same quarter, they are down around 7%. That is a comparative metric. If Saint Laurent, we can see again down 12%, with the others also down. The only one was up by around 3% was the Kering eyewear. Now, overall, their total revenues we can see down 13% versus what was reported, as well as 9% versus the comparative. And you could argue that is why we have seen essentially the share price decline. It has dropped by around 2.5% over the last month, but over the longer term, it has essentially been hammered down 17%. Now, a few other things to note if you are interested in their revenue breakdown by region. Their biggest region so far is Asia Pacific, up around 1 percentage point on the year-on-year basis. And then you have Western Europe at 30% and North America, which interestingly is down from that comparative 4 percentage points. So those are some facts and figures just to think about when we are running through our analysis. Now, the price is in dollars, but it does also report in euros. It is $430, and we did see earlier that ticker symbol for those that are interested, PPRUF, if you are looking to buy in US dollars. Now, starting off, it is a 53.4 billion market cap, so it is a large cap company. Now, dividends, this is what we love as dividend growth investors. Their last full year increase, 17%, double digits. Last 5 years, 18%, very strong. Last 20 years, 9%, well above that 4% inflation rate that we look for as a minimum. But one thing to note, 2018, they did in fact cut that dividend to 2019, and it was maintained before increasing. So just a few things to bear in mind, but over the longer term, that dividend growth has been very strong. Earnings, again, data there for investors that like to take a look. Let's look at the free cash flow. As always, earnings is susceptible to manipulation by management through accounting, and therefore we do see some differences. And as always, dividends are paid out through the free cash flow, not the earnings. So what we can see, personally, 60% or below is what I like to see. Gives me faith that management can offer those double-digit dividend increases that we have come accustomed to and that we can see for this lovely company. So when we take a look, it has been, in fact, been below 60% for the majority of the last 10 years. And over the last few years, between 38 to 54%. So that is positive to see. It does give me faith that they do have that ability to pay out those double-digit dividend increases. But bear in mind, given that their sales has started to slow down over the last year, due to, you could argue, the macroeconomic conditions, if there is a recession, consumer spending is halted, then maybe this company may not pay off those large dividends we have seen the double digits. Now, likewise, earnings per share data available there for investors that like to take a look. On the free cash flow per share, well, 4.56 in 2013, 25.70 in 2022. So you can see some nice growth, nearly 6 times growth on that free cash flow per share, with expected 2023 to go up to $34, even higher than the peak at 2021. So very positive in that respect. Now, sales growth, we do like 3 to 7% as a minimum. Double digits always gets us very excited if it is consistent. But what we can see, it has had a few years of double-digit negative growth. The one positive that I would say from this is every single year after it's had that double-digit negative growth, it has bounced back very strongly. 26% in 2018, 35% in 2021. And we can see their most latest annual report at a 15% increase. Now, numerically, essentially showing us that their top line has essentially doubled over the last 10 years, 9.66 billion to 20.4 billion. So very positive to see that, especially if it can continue. Shares outstanding, very, very simple. They've only bought back 3 million shares from the data that we can see over the last 10 years. So not really much to state on that point. ROIC, as always, 10% or more is what I'm looking for. It does mean management can effectively allocate their capital. Over the large part, you would argue it has hit that or nearly hit that and more with the latest 2 years at 20%. So I'm happy with management. Those are some strong ROIC metrics for the industry. Operating margin above 16% is what we like to see. It has been around that or higher consistently. That is positive. In the mid-20s over the last few years. And with a free cash flow margin around 7% or more over the last 6 years, it has hit those strong numbers, and I would like to see that continue. And finally, the net debt to earnings before interest, tax, depreciation, and amortization, that will effectively sort out that dividend safety. So if the dividend safety is lower, you would expect that their balance sheet is looking poorer. Below around 3.54 is what we look as a maximum, essentially the number of years it would take the company to pay off all of their debt net of cash on hand. The last few years below 2, so it is positive to see. Whilst it is expected to go slightly higher in 2023, it is still lower than that threshold of 3.5. So far, I would say that is positive. No real worries with the company, their balance sheet, and that dividend paying ability. As always though, if you do enjoy the content, value is being provided, do hit that like button, do subscribe and hit the bell to be continually notified of these videos. And if you want to grab a copy of the valuation model we're about to run through to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. So we have our first model, Graham's Valuation. The stock ticker, this is the USD one, PPRUF. Earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds. Remember, the higher that current yield goes, the lower the intrinsic value. Based on this, we see an intrinsic value of $365, which signals it is overvalued in the current market, and it is also lower than that 52-week low. Do bear in mind, though, that we're not looking at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. We then have two companies that we looked at over the last 5 years total return comparison. We have, I'm not even going to be able to pronounce this, and Burberry. The stock price, the earnings per share, the PE multiples, average PE multiplied by the earnings per share of Kering to get a stock price multiples valuation model of $460. As we can see, some nice upside to the current trading price at around 8 to 10%, slightly higher than the current 52-week midpoint. And as always, do bear in mind this is just one of the models that we're looking at, but that is showing some signs of undervaluation currently. We then have the dividend discount model with the yearly dividends over the last 4 or 5 years. Forward looking, well, we've gone for 6%. The average is around 10.71, but bear in mind, we are looking to be a little bit more conservative, especially with the macroeconomic and consumer spending slowdown. But as always, if you do want to look at a higher or lower percentage based on your own estimates and investment thesis, do grab a copy of the model below. This gives a DDM price of $742. And when we take a look, that is higher than the current 52-week high, above the current trading price, showing signs of undervaluation in the market currently. And then we move on to the fourth and final model, the DCF model with the free cash flow year on year, average growth rate, and then we see the growth rate per analyst estimates. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, arrive at the equity value, and divide by shares outstanding to give a DCF price of $692, which is slightly higher than that 52-week high, again showing signs of undervaluation in the current market. Now we get to our intrinsic value, and regular viewers, we know that this is the average of the 4 models we have just run through, and this comes to, in today's case for Kering, an intrinsic value of $565. Now with the current price at $430, 10% margin of safety, remember if you believe it to be a wide moat, strong financial metrics, good forward-looking data, a buy up to $508. Those looking at a 20% margin of safety, it is a buy up to $451, and at 25%, it isn't too far off the current price. So right now, you are getting between a 20 to 25% margin of safety. What do Wall Street say? Well, they believe over the next 12 months, the price will go up to around that intrinsic value at $556. So they do see some nice upside to that current market price. As always, let me know, is Kering one that you hold in your portfolio? Is it one you're looking to buy? Or even if you're just on the sidelines speculating, what do you think about the company? Are you bearish or are you bullish on luxury spending over the next few years? Don't forget to hit that like, subscribe and bell if you want to be continually notified of these videos. And as always, if you want to grab a copy of the valuation model to get to your own acceptable buy price, do click on that pinned comment below. And as always, if you want to come and join us in the Discord, then do click on that Patreon link below, talking all buys and sells in the market. As always, have a great day. Catch you on the next episode. Don't forget to like. Have a good day.